G'day everyone and welcome to This Explainer. Okay, if you've been investing in the Aussie market for more than 5 minutes, you have absolutely heard of the ultimate set and forget stocks. I'm talking about the legendary, unquestioned, safe haven status of Australia's big four banks, CBA, Westpac, ANZ and NAB. I mean, for decades now, this has literally been the bedrock of Aussie retirement. But we have to ask, are we resting our financial futures on a foundation that's actually starting to crack? Today, we're going to challenge that exact foundation. We're diving into the cold, hard data that suggests this impenetrable banking fortress might be under way more pressure than any of us really want to admit.
All right, let's dive into how we're going to break this all down today. We'll be looking at the safe haven myth, the modern mortgage war, the margin squeeze, portfolio concentration risks, and finally, rethinking your bank dividends. Let's get right into it.
Part 1. The safe haven myth.
To really get where we're going, we first need to ground ourselves in that traditional Australian investment mindset. You know the one. If you want a safe bet and a fat dividend, you just buy the big four banks, tuck them away in your bottom drawer, and forget about them. That right there, that is the classic golden rule of Aussie investing. It's practically an inheritance, right? Passed down from generation to generation. And to be fair, you can totally see why it became such a massive habit. We've had decades of nearly uninterrupted economic growth here, backed by these monumental, once-in-a-generation property booms. For the longest time, buying bank shares was basically a license to print money. You bought them, you held them, and twice a year, those sweet, fully franked dividends just rolled in to fund your retirement. But what happens when the actual mechanics that made this rule true start to fundamentally shift? That is exactly what we are unpacking today. Because this old strategy of just blindly setting and forgetting, well, it might actually be the biggest blind spot in your entire portfolio right now.
Which brings us to Part 2. The modern mortgage war. So for ages, the big four were sitting pretty. They enjoyed this protected fortress, controlling the vast majority of the lending market without even breaking a sweat. But today, that fortress is actively under siege. We're seeing this massive, stark contrast in how modern banking actually works. On one side, you've got your traditional big four. They carry enormous legacy overheads, thousands of physical branches, ancient IT systems, huge admin teams. But on the other side, the attackers, these lean, digital-first lenders and nimble fintechs. Because these new players aren't bogged down by heavy real estate and operational bloat, they can offer much tighter rates to steal away customers. And here is the real game changer. Switching banks used to be an absolute nightmare of paperwork, right? Our own laziness literally subsidized the big four's profits. But today, a home buyer can compare mortgages on their phone and switch in just a few clicks. They're not strolling into a high-street branch anymore. They are ruthlessly hunting for anyone who can shave even 0.5% off their interest rate. And these digital disruptors, they are more than happy to oblige.
Moving right along to Part 3, the margin squeeze. Okay, let's lift the hood and look at the internal mechanics of how this aggressive mortgage war is fundamentally hitting the bank's bottom lines. To do that, we got to talk about the net interest margin, or NIM. I know it sounds like dry financial jargon, but it's actually incredibly simple. NIM is just the difference between what a bank pays you for your savings and what they charge other people for their loans. That's it. It is the absolute core engine of a bank's profitability. Now, in a world with higher interest rates, standard logic says, oh, the banks must be making an absolute killing, right? Just hike up the mortgage rates and watch the cash roll in. But the reality on the ground right now is way more complex. That core profitability engine is being squeezed tighter than it has been in years.
Let me break down exactly how this cutthroat competition is squeezing that all-important net interest margin from both ends at the exact same time. Imagine you run a business, right? Your supplier suddenly demands 5% more for raw materials, but your customer flat out refuses to pay even 1% more for the finished product. That is exactly the dilemma the Big Four are facing. Step 1. Competition for your deposits is so incredibly fierce right now, they're having to pay out much higher interest rates just to keep your cash sitting on their balance sheets. That drastically spikes their funding costs. Step 2. At the very same time, to survive that vicious mortgage war against the fintechs we just talked about, they have to charge less to win over homebuyers. So they're paying out more to depositors while bringing relatively less in from borrowers. They're actively slashing their own margins just to keep their market share. And the harsh mathematical reality of that, it means less profit left over for you, the shareholder. That easy, effortless growth we saw over the last decade is vanishing.
All right, Part 4. Portfolio concentration risks.
Let's shift gears and make this personal. How does all this macroeconomic stuff actually impact your retirement portfolio? Well, if you look at a standard Aussie investment portfolio, it's often structurally unbalanced. The ASX 200 is already super top-heavy with financial institutions, so if you just own a standard broad market Aussie index fund, you automatically own a massive chunk of the Big Four. But here's where the psychology gets tricky. A lot of folks think, hey, I own an index fund, so I'm well diversified. But then they follow that old golden rule we talked about and buy individual shares in CBA or NAB on top of it. By doing that, you're basically doubling down on a single sector. Actually, scratch that. You could be massively overexposing yourself. You might literally have 70% of your entire financial future sitting in one single banking basket. From an analytical standpoint, having this level of concentration isn't just risky, it's a recipe for a stagnant portfolio if the banking sector faces serious headwinds.
And here is the real-world danger of that massive concentration risk. The banking sector doesn't exist in a vacuum. It is intrinsically tied to the Australian housing market. Think about how inflation and sequential rate hikes hit the average family. Groceries go up, energy bills go up, and suddenly that monthly mortgage payment is just completely unmanageable. If the property market takes a serious hit, or if we see a spike in mortgage stress where hardworking people literally can't keep up with their minimum repayments, the banks are the absolute first ones to feel the heat. A family defaults, the bank takes the loss. It starts as a localized, household issue, but it rapidly triggers a macro chain reaction that directly batters the most dominant, concentrated sector of your personal portfolio.
Which leads us to our final section, Part 5, Rethinking Your Bank Dividends.
This right here is arguably the most critical takeaway for retail investors today, understanding just how fragile those famous payouts might really be. Look, we all absolutely love our franking credits in Australia, no doubt about it. But a dividend is only ever as good as the underlying profit supporting it. Let's map out this chain reaction. First, as we covered, we've got shrinking net interest margins. The bank's core engine is sputtering. Second, as mortgage stress rises, banks are legally required to set aside more cash to cover bad and doubtful debts. This is capital that just vanishes straight from the profit pool because the bank projects those loans are simply never getting paid back. Finally, when you combine those shrinking profit margins with rising cash reserves locked away for bad debts, those once ironclad payout ratios, they start looking incredibly shaky. The excess cash required to pay those fat dividends simply isn't flowing in like it used to.
Now, let's be totally objective here. We're not saying the dividends are going to evaporate into thin air tomorrow. Don't go running for the hills in a panic. But we have to face facts. The days of reliable double-digit growth in bank dividend payouts, they might very well be behind us for this economic cycle. Historically, you could count on bank dividends growing healthily every year, easily beating inflation and giving you a rising income stream. But today, just maintaining the current payout is a struggle for them, let alone growing it. That historical set-and-forget growth cycle has fundamentally changed. Blindly relying on it to infinitely fund your retirement is a strategy that desperately needs a serious reality check.
So, what's the game plan? How do we adapt? Here is your strategic pivot. First things first, avoid panic selling. Liquidating your entire bank portfolio tomorrow morning is rarely a good idea. Second, you've got to consciously let go of that absolute safe haven mindset. Recognize that these are cyclical businesses facing really stiff headwinds. They aren't magical money trees. Third, actively look at the data. Are your bank shares actually outperforming a global index, or are you just holding onto them for pure nostalgia? And finally, proactively hunt for robust growth opportunities in other sectors. If the banks are stuck playing defense just to survive, you need to find growth somewhere else. Expanding your view into areas like our rapidly innovating Aussie tech sector or our traditionally powerhouse resources sector might just give you that forward momentum the banks are struggling to provide.
The Australian financial landscape has shifted dramatically, and that bottom drawer might not be the safest place to stash your wealth anymore. So I have to ask, are you still a firm believer in the Big Four, or are you actively looking elsewhere? Understanding the real underlying risk in your portfolio is the absolute first step to truly mastering it. Thank you so much for joining me for this explainer, and keep learning.